Welcome to Investment 360, your wrap of the top funds and investment insights in South Africa and beyond. My co-host is Warren Dick. Now, coming up on the show, we chat to Warren Ingram, director at Galileo Capital, or rather, he is the author of Becoming Your Own Financial Advisor. And later, we're chatting to Paul Hansen, director of retail investing at Stanlib. Remember to follow us on at CNBC Africa. Now, just let's talk to Warren, who is in the studio. How do you feel about having got yourself a book under the belt?
Oh, it's fantastic. I mean, it was a lot of hard work, but I'm really glad it's out there, and the reception's been very good from the readers so far.
Well, I tell you, Monique Senecal, who is the producer of Investment 360, is so excited about your book. She has said that she has taken to heart the fact that you need to invest 5,000 Rand a month, and the outlook is that you can become a millionaire in 8 years' time. Warren, is this the reality?
Yeah, I think so. I mean, I think we've got real life case studies in the book of someone who's actually done it, and it's certainly a possibility. I think it just takes a bit of discipline, and most of us really struggle to put that first 5,000 Rand a month away. But if you do, then definitely it's not a fiction; it's real. It's possible.
Become your own financial advisor. Warren, have you taken some advice from this?
Yes, absolutely. I think Warren, we've chatted before, but obviously the focus I've been interested in for my column, and also we've had you on the show here talking about what investment classes to use, and you're a very big proponent of ETFs. So just take us through why you elect again to use ETFs instead of active fund managers.
Well, I think, there's two parts to the answer. One is about cost, and if you do the studies over long periods of time, low cost investments always perform better over 10, 12, 15, 20 years. And one of the things that indexation has in its favor is that it can be very low cost. So that's the one aspect to it. And then I think the other aspect is whether fund managers can actually beat the market. And certainly history has shown 2 or 3 out of 10 fund managers will beat the market, and often they'll do it quite well, but the vast majority of fund managers can't. And my feeling is I don't really want to take that chance. I don't want to be gambling with a 20 or 30% chance when I know I can be right 70% of the time.
But you are prepared to gamble in some respect when it comes to 1 or 2 asset managers out there.
Yeah, so I think there is, there's no doubt that a quality asset manager who has a rigorous process can beat the market. And one of the things that we have seen in South Africa and overseas is that those asset managers that get it right spectacularly. So yes, I think probably the ideal combination would be to have the majority of your money in an index, and then a portion of your money in an active fund, which you then stick to for a long period of time. Give the fund manager a good chance to beat the market, over very long periods of time.
You're quite specific in your choice there that you've got a value bias. Would that be fair?
That's 100%. If you ask me, what style of money management has the greatest chance of beating the market over a long period of time on a sustainable basis, to me it would be value managers, as opposed to growth at a reasonable price, or managers who don't really have a style. They almost trade on instinct, and that makes me very uncomfortable.
Warren, we obviously wanted to pick your brain on what investors should do with lump sums at the moment in the current environment, but we'll get to that a little bit later. I just wanted to ask you one more question. We've got a number of asset managers at the moment that are delivering stellar results. I'm not going to mention them now because they are just producing the goods. And I have I have a debate with them when I talk to them about what is the optimal level in terms of the amount of money they can manage before it starts to affect their performance. And I get obviously some very sophisticated answers. The active managers you use, which ones of them, what's your sort of thinking around when they get so big, it becomes a problem for them to deliver those?
Can I throw some names around?
Yeah.
Coronation, Alan Gray.
Yeah.
Loud enough.
Yeah, and Ford, I think you need to add them to the mix, and they've done extremely well. So if you look at those, and I think Ned Group are probably in there as well with some of their funds. The problem is that they become so big, and I think that's exactly my concern. Is Alan Gray's unit trusts are like massive oil tankers in a tiny basin. At some point, the market is just too small for them to really give you that massive outperformance. At some point, they can just avoid making big mistakes. And that's a concern.
But that point's already arrived. Warren, when we were looking at those performances, Alan Gray was nowhere to be seen on any of the tables.
That's right. Over 1-3, we did the exercises over 1, 3, and 5 years. So I think we're starting to see that already. But you don't want to jump the gun too early, because sometimes the performance comes back They go through periods of underperformance, but certainly with Allan Gray, they've become the market. They've become so big.
Yeah.
So is that out of bounds for you then?
Just because of size, and I think I'm not really a big fan of performance fees. So that's another thing that would bug me a little bit. Is I think if you're an active manager, you should either charge performance fees only or an annual fee, but not a combination. I'm never comfortable with that. So to answer your question, I think I would always try and find smaller managers that have a good value bias in the way that they choose money, and that limit the size of the assets that they would look after, because our market is just so small. I mean, investable shares in the market maybe 120, maybe, So I think there's just not a lot of shares to choose from. So yes, I think smaller value managers for me would be my pick. I must tell you that's not a great call right now. I mean, the value funds just across the board, value managers are not having the best of time at the moment.
You have to have the stomach for it.
Yeah, I think ask John Bickard from Investec. He's having I think he's having a tough time now. Doesn't mean he's a bad manager. It just means that value is just not the flavour of the month at the moment.
Talking about Allan Gray, we looked at some research earlier this week talking about the valuation of the market, and actually Allan Gray are making the argument that the market is very expensive at the moment, and we wanted to get your thoughts on what investors that have lump sums to invest right now should be doing. So I wanted to put that to you. South African equities, offshore, fixed income, you can use whatever asset class you want.
So the point about South African shares is probably right. The overall market is expensive, and it's certainly not at all-time highs in terms of valuations, although the index is at all-time highs. But the PE of the market, let's say it's 17 or 18. I'm not sure what they would say at the moment, but somewhere around there. The long-term PE of the market is, let's say, closer to 14. So yes, it is expensive. It's not a 21, which is where it has been in the past. But I think one thing to understand about shares, you earn about half your return from the stock market by reinvesting your dividends over long periods of time. So if you're sitting on a lump sum on the sidelines, in other words, you've got it in cash, earning a fantastic return of 4% a year, what you're doing is limiting the return that you're going to get from your investments by a huge margin, by 50% if we're talking about shares. So what I would say to an investor is, yes, the market is expensive here. It doesn't mean you should avoid the market altogether. You should probably be sensible, phase in your money to the local market over a 12-month period. Bonds, especially international bonds, is a tricky asset class for me. It's probably the first time I would say in my career where I would say avoid an asset class altogether, because I just think international bonds, especially US and European bonds, to me, if you allocate the lump sum to those assets now, you have a real chance of a permanent loss of capital, because they are going to lose money at some point. International equities are good. I think they still offer some kind of value, but I think you've got to also worry about costs as well. How expensive are these asset classes in terms of you being able to buy them and access them? That's always the problem for a South African, is how do we buy international shares cheaply, cost effectively?
Go ahead.
So if you've got, you're saying if you've, just an interesting point here, because we've had some debates with other financial advisors on the show as to the phasing in argument. How long do you phase in? Do you phase in, or do you just go ahead and invest a lump sum? You indicated 12 months. So effectively that would take, if you had 100,000 Rand, 100,000 over
12 months.
Equally split over 12 months.
Yep. And fair enough, the number crunchers will tell you that 9 times out of 10, or not 9 times, but there's a higher chance that you would do better just allocating all your money in one shot. But I'll just, those people, what they lose sight of is, for example, the major crash, the devastating crash. And if a devastating crash hits you 2 or 3 months after you've allocated your lump sum, it could take you 10 or 12 years to get your money back. Ask the Americans who invested in late 99. They didn't get any growth in their assets until very early in this decade. So that's a long time to get no growth. And to me, I'd rather phase my money in and know that at least if there's a major crash, at some point I'm going to get those assets at a great price. And if there isn't a major crash, at least the early part of my money has had some growth.
Something's been worrying me with the title of your book, Become Your Own Financial Advisor. Are you not doing yourself out of a job once you've educated everybody in terms of becoming their own financial advisor, Warren? Did you think about that?
I must say I had some hate mail from advisors and agents out there with that title. There's actually a chapter on how to choose a good advisor. I think one thing to understand about money nowadays is it's so complicated. There's so many aspects to having your will done, doing your estate planning, doing your insurance, then managing your investments, how to save, that I think it's difficult even for advisors to be competent in all those areas. So I think the idea of the book is to give someone enough information information that at least if they're going to engage an advisor, they can filter out when they're getting a story and when they're getting the facts. They can filter out the good advice from the bad advice. And if they do want to have that, or they do have that inclination, they can actually manage their own money. And I think that's natural. You know, there are people out there who want to do it themselves. So at least the book gives them the stepping stone to do it.
Warren, I wanted to ask you this question as an independent author of a book and a market commentator. How much should South Africans be paying for financial advice? And perhaps you could break it down, because the upfront fee seems to be evaporating, but I know there are still people that pay up to 3.5% of their assets that they're handing to their financial advisor upfront as the fee. What are your guidelines, and where do you draw the line between what's too expensive, just simply too expensive for financial advice?
Yeah, I think it's a great question. It's hard to give you sort of a random amount or a percentage, because if you are very young and you've got a very small amount of money to invest, then you know, if you want great advice, you're going to have to pay for it. And just like a great lawyer or a great accountant, they're going to charge you a large amount of money to give you great advice, and that has a real cost. So it's difficult to relate it to an exact percentage. I mean, what I'd say is, what's the price of having bad advice? And that's devastating. So I think if you're being charged an ongoing fee, you don't want to pay more than 1% a year to an advisor for great advice. If we're talking about upfront fees, I'm kind of uncomfortable with percentage upfront fees. I would rather the advisor says to you, look, if you're small and your life is reasonably small in terms of the amounts of money and your life's simple, let's charge you 6,000 or 8,000 Rand for a plan. We put a plan together and we implement the plan for you.
Moment of truth, your best investment decision ever?
Great question, actually. So I think, I was one of the very early investors into Satrix 40 right in the beginning, and that's been a great deal for me.
I'm sorry to always leave the negative for you, Warren.
Well, thanks, Bon. I have to ask, the worst financial advice you've ever given anyone?
The worst financial advice.
And I'm asking that almost out of respect, because I know you're a good financial advisor and I know you're very honest.
And you've won awards.
So I gave it to my uncle, I think in the late 90s, when he needed to put some of his retirement money away. It was the time when emerging company unit trusts, remember those, were the flavor of the month. And I said to him, we need to allocate about 20 or 30% of your retirement assets to these emerging companies. Bearing in mind, I think I was in my second year on the job. And I must say that did spectacularly badly for him. I mean, it really was bad advice. Luckily, the other advice compensated.
Warren, thanks so much for your time. Warren Ingram, who is the author of Become Your Own Financial Advisor. After the break, we chat to Paul Hansen, Director of Retail Investing at Stanlib.